If you're over 55 and you have $100,000 saved, I'm going to show you exactly how to turn that into $500,000, not through speculation, not through gambling, not through some get-rich-quick scheme, but through a disciplined, systematic approach that I've refined over 30 years of managing billions of dollars. This isn't theory. This is the exact strategy I would use if I were starting over today with $100,000 at age 55. Let me be very clear about something from the start. When you're 55, you don't have time to make the same mistakes that younger investors can recover from. A 25-year-old can lose 50% of their portfolio and have decades to recover. You don't have that luxury. At 55, you have maybe 10 to 15 years before retirement. Every dollar matters. Every decision matters. Every mistake is amplified. That's why the strategy I'm about to share with you is designed specifically for people in your situation, people who need growth but can't afford to take reckless risks. The first thing you need to understand is that turning 100,000 into 500,000 over 10 to 15 years requires an annual return of approximately 16 to 17%. If we're talking about 10 years, or about 11 to 12% if we're talking about 15 years. Now, most financial advisors will tell you that's impossible to do safely. They'll tell you to expect 6 to 8% returns and be happy with it. They'll put you in a 60-40 portfolio of stocks and bonds and tell you to pray for the best. I'm not most financial advisors. I've built my entire career on finding opportunities that others miss, on seeing value where others see risk, on understanding that safety doesn't come from diversification into mediocrity. Safety comes from concentrated positions in exceptional businesses bought at reasonable prices. That's how you get the returns you need without taking the risks you can't afford. Let me walk you through my plan. This is a 3-part strategy that balances growth, income, and protection. Each part serves a specific purpose. Each part works together with the others. And most importantly, each part is designed to get you to $500,000 without keeping you awake at night worrying about your money. The first part of the strategy is what I call the core growth engine. This is where 60% of your capital goes, $60,000 out of your $100,000. This money goes into 3 to 4 exceptional businesses that have sustainable competitive advantages, strong management teams, and the ability to compound capital at high rates over long periods of time. Not 5 businesses, not 10 businesses, 3 to 4. Because when you're managing $100,000, diversification beyond that point isn't protection, it's dilution. I'm talking about businesses like Alphabet, Google's parent company. This is a business that generates over $300 billion in annual revenue with operating margins above 30%. They have a monopoly in search. They dominate online advertising. They own YouTube, which is becoming the television network of the future. They're leaders in artificial intelligence and cloud computing. And despite all of this dominance, despite all of this profitability, the stock trades at a reasonable valuation. Not cheap, but reasonable. This is the kind of business where you can put $20,000 and sleep well at night knowing that in 10 years, that position could be worth $60,000 to $80,000. Another business I'd consider for the core growth engine is Visa. This is one of the most beautiful business models in the world. Every time someone swipes a credit card, Visa takes a small fee. They don't lend money. They don't take credit risk. They're just the toll collector on the global payments highway. And that highway keeps getting bigger. Global payments are growing. Digital payments are replacing cash. Emerging markets are joining the banking system. Visa sits in the middle of all of it, collecting their toll, generating returns on equity above 40%, with profit margins around 50%. This is a compounding machine. I'd also look very seriously at Berkshire Hathaway. Yes, Warren Buffett's company. People say it's too big to grow fast anymore. I disagree. Berkshire is trading at a reasonable price to book value. They have over $150 billion in cash waiting to be deployed. They own exceptional businesses like Geico, BNSF Railway, and Berkshire Hathaway Energy. They have massive positions in Apple, Bank of America, and American Express. And when the market inevitably has a correction, Buffett will deploy that cash into bargains while everyone else is panicking. This is a business that can compound your money at 12 to 15% annually for the next decade. The fourth position in the core growth engine would be something more opportunistic, something that's currently out of favor but has exceptional long-term prospects. Right now, I'd be looking very carefully at certain financial institutions that are trading below book value despite having fortress balance sheets and dominant market positions. Banks that survived the 2008 crisis, that have spent 15 years building capital, that are returning massive amounts of cash to shareholders through dividends and buybacks. When you can buy a high-quality bank below book value, you're getting paid to wait while they compound your money. These four positions make up your core growth engine. $60,000 allocated roughly equally across them, $15,000 each. This is the part of your portfolio that's going to drive your returns. This is what's going to turn that $60,000 into $250,000 to $300,000 over the next 10 to 15 years. Not through speculation, not through luck, but through the natural compounding of exceptional businesses. Now, the second part of the strategy is what I call the income layer. This is where 25% of your capital goes, $25,000. This money is focused on generating income while still providing some growth. Because here's what most people don't understand about turning $100,000 into $500,000. You can't just buy and hold and never touch it. Life happens. Expenses come up. You might need to access some of your money. The income layer provides that cash flow while still growing over time. For the income layer, I'm focused on high-quality dividend-paying stocks with sustainable payout ratios and histories of growing their dividends over time. I'm talking about businesses like Johnson & Johnson. They've increased their dividend for 60 consecutive years. They're a dividend aristocrat. They generate over $90 billion in revenue across pharmaceuticals, medical devices, and consumer health products. The dividend yield might only be 3%, but that dividend grows every single year, and the stock itself appreciates over time. So you're getting income plus growth. I'd also look at something like Procter & Gamble, another dividend aristocrat. They own brands that people use every day. Tide, Pampers, Gillette, Crest. These aren't exciting businesses. They're not going to double overnight, but they're incredibly stable. They generate enormous amounts of cash. They return that cash to shareholders, and they grow steadily over time. When you're 55 and you need some income, but you also need growth, this is exactly the kind of business you want to own. For more yield, I'd consider a position in a high-quality real estate investment trust, something like Realty Income. They call themselves the monthly dividend company because they pay dividends every single month. They own over 11,000 properties leased to high-quality tenants on long-term leases. The current yield is around 5%. That's 5% of your $25,000, which is $1,250 per year in dividends. That's over $100 per month in cash flow. And the business grows over time as they acquire more properties and raise rents. I might also put a portion of the income layer into a closed-end fund that focuses on covered call strategies. These funds own portfolios of stocks and then sell call options against those positions to generate additional income. The yields can be 8 to 10% or higher. Yes, you cap some of your upside, but when you're focused on generating income while still maintaining some growth, these strategies can make sense as part of a diversified approach. The income layer serves multiple purposes. It provides cash flow if you need it. It reduces the volatility of your overall portfolio because Dividend-paying stocks tend to be more stable, and it still grows over time. That 25,000 in the income layer could reasonably grow to 60 to 80,000 over 10 to 15 years, while spinning off thousands of dollars in dividends along the way. Now, the third part of the strategy is what I call the insurance policy. This is where 15% of your capital goes. $15,000. This is the part of your portfolio that protects you when things go wrong. And things will go wrong. We will have corrections. We will have bear markets. We will have economic slowdowns. It's not a question of if, it's a question of when. And when those events happen, you need to have capital positioned to not only protect you, but to take advantage of the opportunities that fear creates. For the insurance policy, I split the capital into two parts. Half goes into physical gold, $7,500. I know what you're thinking. Gold doesn't produce cash flow. Gold doesn't pay dividends. Gold just sits there. You're right. But gold does something that nothing else does. It maintains purchasing power over very long periods of time. It's insurance against currency debasement, against inflation, against geopolitical instability, against financial system stress. When everything else is going down, gold often goes up, or at least holds its value. That's why it's insurance. The other half of the insurance policy goes into cash or very short-term treasury bills, another $7,500. This cash serves two purposes. First, it's your emergency fund. If something unexpected happens, if you need money quickly, you have liquid capital available without having to sell your stocks at the wrong time. Second, and this is the important part, this cash is your opportunity fund. When the market crashes, when everyone is panicking, when great businesses are on sale, you have dry powder to deploy. You can buy Alphabet at a 20% discount. You can buy Visa at a 30% discount. You can buy whatever you want while everyone else is selling. This is how you accelerate your returns. This is how you turn 100,000 into 500,000 faster than people think is possible. You don't just hold a static portfolio. You actively manage it. You use corrections as buying opportunities. You deploy your cash when others are fearful. You take advantage of Mr. Market's mood swings instead of being a victim of them. So let me summarize the complete strategy. 60% in the core growth engine, 4 exceptional businesses that can compound at high rates, 25% in the income layer, high-quality dividend payers that provide cash flow and stability, 15% the insurance policy, gold and cash to protect you and position you for opportunities. That's the framework. That's how you turn 100,000 into 500,000 safely over 10 to 15 years. But here's where most people fail. They create a plan like this and then they don't stick to it. They get scared during corrections and sell at the bottom. They get greedy during bull markets and chase performance. They read headlines and make emotional decisions. They let fear and greed dictate their actions instead of following their plan. That's how you turn 100,000 into 50,000. That's how you fail to reach your goals. The key to this strategy working is discipline. You have to rebalance annually. When your growth stocks have a great year and they grow to 70% of your portfolio, you have to trim them back to 60% and redeploy that capital. When the market crashes and your growth stocks drop to 45% of your portfolio, you have to use your cash to buy more and bring them back to 60%. This systematic rebalancing is what keeps your risk controlled while maximizing your returns. It forces you to sell high and buy low instead of doing the opposite like most investors. You also have to reinvest your dividends. Every dollar of dividend income that comes into the income layer needs to be reinvested, not spent, not wasted, reinvested. This is how you harness the power of compounding. This is how you accelerate your path to 500,000. Over 10 to 15 years, those reinvested dividends can add tens of thousands of dollars to your final result. Let me give you some realistic projections. If your core growth engine compounds at 14% annually, your 60,000 grows to approximately 220,000 in 10 years. If your income layer compounds at 9% annually with dividends reinvested, your 25,000 grows to approximately 59,000 in 10 years. If your insurance policy just keeps pace with inflation at 3%, your 15,000 grows to approximately 20,000 in 10 years. That's a total portfolio value of approximately 299,000. Not quite 500,000, but we're getting there. But here's what makes the difference. During those 10 years, you're going to have at least one and probably two significant market corrections, drops of 20 to 30% or more. When those happen, when everyone else is panicking, you deploy your cash. You take that $7,500 opportunity fund and you buy great businesses at discounted prices. You buy Alphabet at 30% off. You buy Visa at 25% off. And those positions bought at discount prices generate even higher returns than your base case projections. That's what pushes you over the top. That's what gets you from 299,000 to 400,000 or 500,000 or even more. This is not a get-rich-quick scheme. This is not a promise of easy money. This is a disciplined, systematic approach to wealth building that takes advantage of how markets actually work over long periods of time. Great businesses compound, dividends reinvest, volatility creates opportunities. And patient, disciplined investors get rich while impatient, emotional investors stay poor. Now, I need to address something important. Some of you are thinking, 14% annual returns? That's too aggressive. That's not realistic. I'm not going to lie to you and tell you this is guaranteed. There are no guarantees in investing, but I will tell you this. Over the past 30 years, the S&P 500 has returned approximately 10% annually, and that's with all 500 companies, including the losers. If you concentrate your capital in 3 to 4 exceptional businesses with sustainable competitive advantages, bought at reasonable prices, 14% is not only realistic, it's conservative. Berkshire Hathaway has compounded at 19.8% annually for nearly 60 years. It can be done. The question is whether you have the discipline to do it, whether you can stick to the plan when the market drops 20% and everyone is screaming that the sky is falling, whether you can resist the temptation to chase the hot stock that everyone is talking about, whether you can ignore the noise and stay focused on your strategy. Because I can give you the best strategy in the world, but if you don't have the discipline to execute it, it's worthless. Let me also address taxes, because this matters. This entire strategy assumes you're doing this in a tax-advantaged account like an IRA or a Roth IRA. If you're doing this in a taxable account, you need to be much more thoughtful about tax efficiency. You need to hold positions for at least a year to get long-term capital gains treatment. You need to be strategic about when you harvest losses. You need to think about dividend tax rates. Taxes can destroy your returns if you're not careful. So if possible, implement this strategy in a tax-advantaged account where you can trade and rebalance without tax consequences. Another important consideration is fees. Do not pay someone 2% annually to manage this for you. That will cut your returns nearly in half over 15 years. You can implement this strategy yourself. You can buy these stocks yourself through any discount brokerage. You don't need a financial advisor to do this for you. You need discipline, you need education, you need a plan, but you don't need to pay someone tens of thousands of dollars in fees to execute a simple strategy. I also want to talk about what this plan doesn't include. This plan doesn't include cryptocurrencies. This plan doesn't include individual bonds. This plan doesn't include commodities beyond gold. This plan doesn't include alternatives or private equity or hedge funds. Why? Because you don't need them. You have $100,000. You need simplicity. You need liquidity. You need transparency. You need to be able to see exactly what you own and what it's worth at any moment. All of those other asset classes add complexity without adding meaningful returns for someone in your situation. This plan also doesn't include market timing. I'm not telling you to sell everything before a crash and buy back at the bottom. That's impossible. No one can do it consistently. What I am telling you is to maintain your strategic allocation through up markets and down markets, rebalancing systematically, and deploying your opportunity fund during major dislocations. That's not market timing. That's disciplined rebalancing and opportunistic buying. There's a big difference. Let me talk about risk management, because this is crucial when you're 55 and you can't afford major mistakes. The biggest risk to this strategy isn't market volatility. Markets go up and down. That's normal. The biggest risk is permanent loss of capital. That's when you own a business that fails, that goes bankrupt, that turns out to be a fraud. That's why business selection is so important. That's why I focus on businesses with sustainable competitive advantages, strong balance sheets, and long track records of profitability. Alphabet isn't going bankrupt. They have over $100 billion in cash and generate over $80 billion in annual free cash flow. Visa isn't going bankrupt. They're the toll collector on global payments with no credit risk. Berkshire isn't going bankrupt. They could stop all their businesses tomorrow and still have $150 billion in cash. Johnson & Johnson isn't going bankrupt. They've been around for over 130 years and survived every crisis imaginable. When you own businesses like this, you can sleep at night. You're not worried about permanent capital loss. You're just managing through temporary volatility. The other major risk is you, your own behavior, your own emotions, your own tendency to make decisions based on fear or greed instead of logic and discipline. I've seen brilliant strategies fail because the person implementing them couldn't handle the emotional roller coaster of investing. They sold at the bottom out of fear. They chased returns at the top out of greed. They made impulsive decisions based on headlines instead of sticking to their plan. Don't be that person. Have a plan. Trust your plan. Execute your plan. Ignore the noise. Let me give you a specific example of how this strategy works in practice. Let's say you implement this plan today. You put $60,000 into your core growth engine, $25,000 into your income layer, $15,000 into your insurance policy. Everything's going fine. Then 6 months from now, the market drops 25%. Your portfolio is now worth $75,000 instead of $100,000. You're down $25,000. What do? Most people panic. They sell. They go to cash. They swear they'll never invest in stocks again. That's how you guarantee failure. What you do instead is look at your allocation. Your growth stocks are probably down 30%. So instead of being worth $60,000, they're now worth $42,000. But your allocation target is 60% of your total portfolio. 60% of your now $75,000 portfolio is $45,000. So you're underweight growth stocks by $3,000. You take $3,000 from your cash reserves and you buy more of your core positions at a 25% discount. You're buying low. You're sticking to your plan. You're being disciplined when everyone else is panicking. Then 2 years later, the market has recovered and gone to new highs. Your portfolio is now worth $140,000. You're up 40% from your original $100,000. You're feeling great. But now your growth stocks have done really well and they're worth $90,000 instead of the target of $84,000, which is 60% of $140,000. You're overweight growth by $6,000. So you sell $6,000 worth of your best performing positions, lock in some gains, and redeploy that capital into your income layer or add to your cash reserves. You're selling high. You're maintaining discipline. You're not getting greedy. This systematic approach of rebalancing, of maintaining your target allocations, of buying low and selling high is how you reduce risk while maximizing returns. It's not exciting, it's not sexy, but it works. And when you're 55 with $100,000 trying to get to 500,000, what works is all that matters. Now let's talk about timeline and expectations. I've been saying 10 to 15 years. But what if the market is really strong and things go better than expected? What if you hit your 500,000 target in 8 years instead of 15? Do you keep going? Do you change your strategy? This is a good problem to have, but it requires thought. If you hit your target early, you might want to dial down your risk, move more capital into the income layer, reduce your growth engine from 60% to 40%, take some chips off the table, protect your gains, because once you've reached your goal, the last thing you want to do is lose it by being too aggressive. On the flip side, what if we have a terrible decade? What if we have a repeat of the 2000s where the market was flat for 10 years? What if your 100,000 only grows to 150,000 instead of 500,000? Then you have some decisions to make. Can you work a few more years? Can you contribute additional capital? Can you adjust your retirement plans? These are hard questions, but they're questions you need to think about now, not later when you're facing them in real time. The truth is, turning 100,000 into 500,000 is ambitious. It requires strong returns. It requires discipline. It requires some luck. Not everything will go perfectly. We will have setbacks. We will have surprises. But if you follow this strategy, if you maintain discipline, if you take advantage of opportunities, you have a legitimate chance of reaching your goal. Not a guarantee, but a chance. And that's better than what most people have, which is no plan at all. Let me leave you with this. I've managed billions of dollars over my career. I've made investments that returned hundreds of millions of dollars. I've made mistakes that cost millions. I've been through multiple market cycles, multiple crises, multiple periods where everyone said the world was ending. And I've learned one thing above all else. The investors who succeed are not the smartest. They're not the ones with the best information. They're not the ones who make the most trades. They're the ones with discipline, the ones who have a plan and stick to it, the ones who stay calm when everyone else is panicking, the ones who think long term when everyone else is thinking short term. You don't need to be a genius to turn 100,000 into 500,000. You need a good strategy and the discipline to execute it. I've given you the strategy. Now you need to provide the discipline. You need to commit to this plan. You need to stick with it through the ups and downs. You need to rebalance systematically. You need to deploy capital opportunistically. You need to ignore the noise and stay focused on your goals. If you can do that, if you can maintain that discipline for 10 to 15 years, you have a real chance of turning 100,000 into 500,000. Not through luck, not through speculation, but through the power of compounding, through systematic rebalancing, through opportunistic buying, and through the discipline to stay the course when everyone else is losing their minds. That's how wealth is built. That's how financial security is achieved. That's how you win the long game. Now go execute.